Should you pay off your loans early or use that money to invest? Tens of thousands of dollars could be riding on your choice. It could even be $1 million decision. Today, we'll look at why this decision matters, and we'll model different real-world scenarios to see which option wins. This debt versus investing workbook was fun to build, and I think you'll be surprised by what it shows you. So get your free copy from the link in the description below and follow along. First, let's define what's at stake. This is you. You've been working 40 hours a week, day in and day out for years. Now you're deciding whether you can afford to stop working altogether. The thing is, this decision was already made for you by you in the past. Past you made this decision more than a decade ago when you enrolled in your employer's 401k match. Then you made it again when you maxed out your IRA. And here you are making the decision when you decide to pay down your debt early instead of investing. Or maybe you went the other way around. And this is us today making that decision and determining whether our wealth is going to grow like this or like this. Our future self hangs in the balance. And now that we know the stakes, let's do the math. Welcome to our Debt versus Investing workbook. Don't forget, you can get your own copy below and follow along. Let's start with defining our loan terms. Let's say we have a large $100,000 loan, a 10% interest rate. If it's 10 years, that puts our minimum payment at about $1,300 a month. Now that we have our loan defined, that's the easy part. Now we need to decide what our expected rate of return is on our investments. And our first step there is to decide what we're going to be investing in. So if we have extra cash at the end of a given month, what will we put it in for our long-term investments? It could be anything from the total market index to the S&P. We could put it into a high yield savings account. We could put it into a money market. We could put it into Pokemon cards, rare koi fish, any number of things. Whatever we choose for our long-term investment will likely have historical returns that we can reference, and that will be our best data point when we're trying to predict what's going to happen in the future with these investments. That being said, past performance is by no means indicative of future performance. We're really just making a projection here. It's not an exact science, not like our loan, where we know exactly what's going to happen, assuming that we have a fixed rate. For our first example, let's do a classic 60-40 portfolio. And the historic return for such a portfolio is about 7.5% on average. And we're not adjusting for inflation because we want to compare apples to apples, and our loan is not inflation adjusted. And let's say that currently in our 60-40 portfolio, we have about $50,000. And let's say on average, we think we'll have about an extra $1,000 per month that we can either put toward our loan or that we can invest. And let's make our time horizon nice and long. We'll do 30 years. So in this example, we can see that prioritizing our debt with that extra cash will earn us an extra more than $500,000 at the end of 30 years. So even with a loan that's only 10 years and a return that's only a 2.5% difference between investing and our loan interest rate, it's still a massive difference. All right, now let's swap in a different scenario and we'll see if we can find something that makes an even more dramatic difference. So let's say instead of a 10-year student loan, we have a 30-year mortgage and we were loaned $500,000, which unfortunately is not rare these days, but we have a good rate. Let's say we have 4%, and that would put our minimum payment at around $2,400 per month. And let's say rather than a conservative portfolio, we're going to do something like the S&P 500 via an index. And historically that returned 10%, not adjusted for inflation. We'll start with the same 50,000 there. And let's say instead of 1,000 per month, we think over the next 30 years, on average, we'll have 3,000 per month that we can put into either our mortgage or our investments. All right, that gives us more than $1 million difference. So here we can see that investing and prioritizing putting our extra cash into that, rather than paying down our mortgage early, will result in us being more than $1.3 million wealthier 30 years from now. That's a great illustration of what a huge difference this decision can make, especially if you're looking at something like a 30-year mortgage. And this is where I must remind you that past performance does not equal future performance. We're simply looking at historic data to model one of infinite possible future scenarios. No one has any idea what the market will do tomorrow, let alone 30 years from now. And that's doubly true for more volatile investments, like Pokemon cards, crypto, or Legos. And of course, this is not financial advice. This is for educational purposes only. For big decisions like this, please always consult with a professional who knows you and your personal situation. And if we scroll down, we can see a month-by-month breakdown, and we can see exactly how these scenarios would play out over time. All right, thanks for coming along on that little journey. Now you have a tool that you can use to plug in your own numbers, and you can see which path will build more wealth for you. And I hope this encourages you to continue thinking long-term about your financial strategy, because decisions that might seem small or inconsequential today can make a huge difference down the line. My name is Kev, and you can get the spreadsheet we used today below for free, and I will see you next time.